Welcome everyone. Appreciate you guys being here. We're super excited to have Chris here today. So he's going to be talking all about 1031s. He's an expert in the field. So he kind of the format is we're going to go. He's going to go over. He has a presentation. He's going to go over that, and then we'll kind of open it up for questions. Probably the last 15, 20 minutes or so, and go from there. And yeah, just excited to see everyone here today. And then if you, for whatever reason, have to jump off or whatever, be sure to send out the recording. So, Chris, hand it over to you if you want to introduce yourself, and we'll go from there.
Sounds great. Well, Dustin, I appreciate the opportunity to be with all of you today. My name is Chris Peterson. I'm the owner and president of WealthBuilder 1031, and we are a nationwide qualified intermediary, which means that we help real estate investors sell their properties and reinvest it in replacement property and defer those nasty capital gains taxes that nobody wants to pay while doing so. And so today, what we're going to do is we're going to cover kind of the basics of 1031 exchanges. Now, I know you guys are going to be very excited to hear this, but we're going to start with some very simple tax concepts because I always like to kind of set a baseline of what we're trying to accomplish with a 1031 exchange. So let's get going. Before I do get started, just a little bit about me. Most people like to hear kind of who I am. And so again, my name is Chris. Besides owning Wealth Builder 1031, I'm also a licensed Texas attorney. You look at me and you say, well, Chris, you haven't been licensed very long. You're so young looking, I'm sure. But I actually have been licensed now for 30 years. And so I still have an active law practice as well. And then I speak all over the country on 1031 exchanges. And so if you're involved in the real estate investment community, you may have heard me talk before, but if you're a member of any kind of real estate group, I'm very frequently a speaker at various conferences around the country. So the whole point of a 1031 exchange is to be able to defer our capital gains taxes. And what we're wanting to do is we want to sell investment real estate. And instead of paying Uncle Sam, we want to keep all those sales proceeds for ourselves and use them to replace that investment in a new property or properties. But often when I talk to folks, what I find out is they're not even really sure what they owe in capital gains taxes. And part of the problem is they don't really know how the math works on capital gains. So I always like to start with a little bit of math and the tax code. What I understand are people's two favorite subjects in life, right? Math and taxes. So how do we determine capital gains? Well, in order to determine capital gains, we really need to know kind of two numbers. The first number is the sales price, okay? And that one's going to be really easy because you're going to find that on your real estate contract, right? So we should not have a problem setting that one. The second one is our tax basis. Because what a capital gain is it's the difference between the sales price and the tax basis that we have in the real estate. And so that difference, that gap is our capital gain. And what we're going to do is once we figured out that capital gain, we're going to multiply it by the applicable tax rate. And that tax rate can go from 15% all the way up to 25%, depending on somebody's adjusted gross income. And so most clients are going to end up paying 15%. So that's always kind of the baseline that I use when doing presentations because that's the one that most people have. So capital gains, sales price minus tax basis. So the question is, then how do we determine our tax basis? And so the tax basis consists of three elements. The first is, hey, what's the acquisition cost? What did we pay for that property? And then we're going to adjust it up for the cost of any improvements that were made on that property. And then we're going to reduce it by the amount of depreciation that we've taken over time on the property. And so everyone's tax basis is always going up and down because think of a property, let's say I bought something for 200,000. I immediately put $100,000 into it. Okay, now my tax basis is 300,000, and then I start depreciating and maybe I take off 20,000 a year on depreciation so that at the end of the first year I'm at 280, at the end of the second year I'm at 260, at the end of the third year I'm at 240, and then I decide to put $50,000 into the property, and so now I'm back up at 290, right? So we see that how it's going up and down. But at the end of the day, once we figure out our tax basis, acquisition cost plus cost of improvements minus depreciation, then we subtract that number from our sales price, and that gives us what our capital gain is. And then we're going to multiply that capital gain times 15%, and that's going to give us kind of a rough number of what our capital gains tax would be. So let's look at kind of a couple of examples. And so the first one is we've got an investor named John, and John has a tax basis in his property for 100,000. And John goes to sell his property for 150,000. And so we've got a 50,000 difference between those two numbers. And so John's capital gain is $50,000. And so you and I would commonly say, hey, John made 50 grand on that transaction. But the truth is, when he goes to closing, you've got John as the seller and you've got his buyer there. But at the closing table, we also have an invisible third party, and that's Uncle Sam. And Uncle Sam is funny because he adds no value to your transaction at all, but he does expect to get paid for it, right? And so off this $50,000 of gain, John is going to owe Uncle Sam $7,500, right? 50,000 times 15%. And so John's going to have to pay that to Uncle Sam. Now, on the other hand, we have another person called Jane. And Jane is an investor. She's a little bit more sophisticated than John. And Jane knows about this weird little provision in the tax code under section 1031, which is how we get 1031. And she knows that if she sells her property and she takes that money and follows the IRS checklist and she reinvests it in one or more replacement properties, she can defer paying Uncle Sam. And so Jane basically has the same transaction as John because Jane is also has a $100,000 tax basis and she goes to sell for 150,000. So she has that same $50,000 of capital gain that John has. But instead of paying Uncle Sam that $7,500, Jane instead uses that along with the rest of the sales proceeds to reinvest in a new replacement property. And by following those rules in Section 1031, she's able to do that and not pay Uncle Sam. So why does she do this? Well, I mean, number one is she has the $7,500 in equity that John didn't have, right? But also think of this long term and the compounding effect of that. Because Jane's going to get all that appreciation off the 7,500 over time and the additional cash flow caused by the 7,500 over time, and it's going to keep compounding. John's missed out on that forever by paying Uncle Sam. And so what we find with investors is they use the 1031, and what they are doing is they're keeping their equity for themselves. They're using that equity, which increases their rate of return, it increases their cash flow, and over time it also reduces their debt service, right? So they kind of get all the good bits of benefits of the 1031 exchange that way. a lot of times when I talk in these terms, I always use these really simple examples, and people say, "Well, Chris, is it really that big of a deal? I mean, it was just a $7,500 tax bill. Who really cares? Is it worth going through a 1031 exchange?" And I always tell them the same thing. Well, what if we added a zero to the transaction? And what if instead of $50,000, we were talking about $500,000? And now we're writing a check for taxes to the IRS for $75,000 instead of 7,500. Now, does it feel more real to us? And is that a check we would not like to write? Well, what if we added another zero? And now we're at 5 million. And now the check we're writing to the IRS is 750,000. Now, do we feel like that's a real hickey that we don't want to pay, that we would want to keep that equity to ourselves? And so that's what we see with the 1031 exchange. As we change the numbers, the savings get bigger and bigger. And of course, the impact is bigger as well. Now, um, there's another little tax concept that I want to talk about. And I actually just took this slide from another presentation, but it fits in really well here. And that's a concept called step up in tax basis. And so the way this works is when somebody inherits a property from another person, okay, at their death, they inherit the property, but they don't inherit the tax basis, okay? And so what happens is the person who gets the inheritance, the beneficiary, their tax basis isn't the tax basis of the decedent. They get a new adjusted tax basis up to the value of the property on the date of death. Okay. And so let's see how this works. Let's say that I've got a property and I've fully depreciated it. Okay. And my tax basis in the property is $1. And the day before I die, I go to sell the property for $1,001,001, right? So my tax basis is $1. My sales price is $1,001,001. So I have $1 million capital gain on that property. Well, if I sell it the day before I die, I'm going to owe Uncle Sam $150,000, right? And he's going to be very happy to cash that check for me. Um, but if instead of doing that, I die and that property gets passed on to my loved ones, they get the property, but they get a new stepped up adjusted tax basis. And so my wife inherits the property. Her tax basis is not my $1. Instead, her tax basis raises up to $1,001,001, the value on my date of death. And she goes, and the day after I die, she sells that property for $1,001,001. Okay. So her capital gain is zero because 1,000,001 minus 1,000,001 is zero. And then what capital gains tax does she owe? Well, we all learned in third grade that 15% times zero is still zero, right? And so what we see is by utilizing the 1031 exchange, we're able to also, besides all the benefits during our lifetime, we're also able, using this other provisions of the tax code, to potentially wipe out all of that deferred capital gain. And so what that looks like is we're going to use these concepts together because we're going to buy property, we're going to depreciate it while we own it, so we get losses to offset our other income. We're going to build equity in the property. When we decide to upgrade or expand, we're going to 1031 exchange so that we're going to continue to defer those taxes. We're going to repeat this over and over and over again. And then when we die and we pass that property on to our loved ones, we're getting this step up in tax bases. And as part of that, we're going to wipe out those capital gains taxes. So you see how all these concepts work together to get you to build wealth and to build that wealth generationally. So here's what we're going to do. I know lots of people have questions about 1031 exchanges. And so the way that the rest of the presentation works is we're going to look at the most common questions that we get asked. And I know these are the most common questions because I had my staff for 90 days write down everything that anyone asked us over the phone. And the ones that happened over and over again were the basis of the presentation. Okay. And so the first one that people ask me is, hey, who can do a 1031 exchange? Who is eligible? And this one is really easy because it's any US taxpayer. So if somebody files a tax return, they're eligible to do a 1031 exchange. So this means individuals, married couples, corporations, partnerships, LLCs, trusts, any tax-paying entity is gonna qualify. This is also going to include foreign investors who have to file a U.S. tax return. And so anyone filing a U.S. tax return for their U.S. investments is going to qualify for the 1031 exchange. Now, what property is going to work for a 1031 exchange? Well, the answer is it's got to be any property that is going to be used for trade, business, or investment purposes. So those are the categories of properties. And a lot of times when we think about it, we're like, well, what does that mean exactly? Really, what it means is it can't be a property that you're using primarily for personal use. That's really the restriction. So if it's for personal use, it doesn't qualify for 1031 exchange, but basically everything else is going to be eligible for a 1031 exchange. So any form of real property used for trade, business, or investment purposes. Now, often we have questions about, hey, does this work or does this not work? And so I'm going to go over three examples of things where it may be confusing as to whether it's trade, business, or investment, or if it's personal use. So the first one is an Airbnb property. So folks buy these, they rent them out some, they use them some. So I don't know whether that's personal use or whether it's trade, business, or investment. Well, the answer is it depends on how many days they use it personally. So the IRS says that the definition of the word primarily is do you use it 14 calendar days a year or less? Okay. If you use it 14 calendar days a year or less, it's trade, business, or investment purpose. If you use it 15 days or more, then that's going to be for primarily personal use, right? A second one that we run into a lot is the person that owns a fourplex and they live in one of the units and they rent out the other units in the fourplex. So is that trade, business, or investment, or is that primarily personal use? Well, this one is really interesting because the answer is both. So when somebody sells their personal home, there's another provision of the tax code under section 121 that says when I sell my personal home, which is somewhere that I've lived 2 of the last 5 years, whatever capital gain comes from that, I as an individual can keep up to 250,000 of that capital gain tax free. If I'm married, I can keep up to 500,000 tax free. And I can use that money for whatever I want, and I don't have to buy any form of a replacement real estate. Okay. And so when we sell that fourplex, we can actually use both provisions of the code together. So we can take 25% of the sales price and attribute it under section 121. And so we can use those exemptions to put some money in our pockets up to that $250,000, $500,000 mark. And the other three-quarters of the property we can sell as trade, business, or investment, and we can 1031 that money into our next investment. Now, the one that we deal with in Texas a lot is the ranch, right? So I've got 100 acres. We live in a house. The house is on the 100 acres, right? And then on the rest of the acreage, I do, I have some cows, or I have hay, or I have honeybees, or I have some kind of wildlife exemption. It doesn't really matter. Okay. So again, my house is there. I live there every day. Is that trade business or investment, or is it personal use? Well, again, the answer is both. And so what we can do in one closing is we can sell the house and maybe an acre and use our 121 exemption and keep the 250, 500,000 and put it in our pocket. And the other 99 acres, we can 1031 exchange into our next real estate purchase, right? And so you see how we can use these provisions of the code together. So if it's not your personal home and you don't personally use it, more than 14 days a year, then it's probably going to be considered trade business or investment purpose. Now, here's the kicker. 1031 exchanges are often called like-kind exchanges, and this is probably the most misunderstood part of 1031 exchanges. And so the question is, hey, what does like-kind mean? Does it mean that if I sell, a duplex in Plano, that I have to buy another duplex in Plano? Do they have to be exactly alike? And the IRS is not very helpful in this because the definition in the code is like-kind property is property of the same nature, character, or class. Quality or grade doesn't matter. Okay? That was obviously written by a lawyer, and I have no idea what it means. Okay? So let's make it really easy. All real estate is going to be like-kind to all other real estate. So all real estate is like kind to all other real estate. So what does this mean in practice? It means I can sell a single family rental and I can 1031 it into a fourplex. I can sell the fourplex and I can 1031 into an undeveloped lot. I can sell the undeveloped lot and 1031 into an apartment complex. I can sell the apartment complex. I can 1031 it into an industrial building. Okay. All of those are like kind exchanges because all real estate is like kind to all other real estate. That also includes things that you and I don't normally think of as real estate. So I can sell that industrial building and I can actually 1031 exchange it into oil and gas interests or commercial water rights because those are interests in real estate. I can also invest in tenant and common properties where I and others co-own a property together. We've got professional management, and each of us own our little sliver, and we get the benefit of rent. We don't have any management headache, and we get depreciation. And of course, as the properties appreciate in sale, then we're also going to get our percentage of the sales proceeds. We also can use it for Delaware statutory trusts. And I'm not going to spend a bunch of time on this, but Delaware statutory trusts work like REITs. REITs are not 1031 eligible, but DSTs are. And so basically, what a DST does is it owns a portfolio of real estate. You're an investor in the DST. Again, the sponsor manages everything, and you get a rent check usually every quarter. You get depreciation at the end of the year for your tax return, and you're also going to have appreciation on the property. And when there's a sales event, you're going to get your percentage of that sales proceeds. The other thing about like kind is it's not geographic specific. So Texas property is like kind to California property is like kind of New York property is like kind to Alaska property. And so you can see that we get hung up on like kind trying to make it be exactly alike, but in actuality, it covers any kind of real estate and it covers anywhere in the country. So what are kind of the typical steps in a 1031 exchange? Well, here's what I want you to know. A lot of people will tell us, well, Chris, I understand that a 1031 exchange is like super, super complicated. And what I always tell people is actually It's technical because it involves the tax code, but the IRS gives us a checklist. And as long as we check all the boxes, the 1031 exchange is really easy. And for the most part, there's not very much addition to what you normally do in a real estate transaction. And so, kind of how the typical steps in a 1031 exchange works is you're going to sell your property, you're going to get a contract on the property. And at the time that we do a contract, we're going to include a clause in the contract that says that we might do a 1031 exchange. It's called a cooperation clause. And it just tells the other side, hey, you're on notice, we might do a 1031 exchange. And oh, by the way, we're going to want you to maybe sign a document or two, but it's not going to cost you anything extra, and you're not going to have any extra liability for it. I've got some examples later on of the cooperation clause, and I'm going to provide the slide deck to Dustin, and he's gonna send it out later. So don't feel like you got to write everything down. So after we sign that sales contract, you're gonna receipt it at the title company just the same as always. Now you've got to hire your qualified intermediary, like our company, WealthBuilder 1031. You've got to hire them before that first closing. Okay. So once you've closed, it's too late to start a 1031 exchange. So you have to have it set up before that first closing. And what's going to happen is sometime prior to that closing, the QI, the qualified intermediary, is going to prepare some tax related exchange documents, the 1031 documents. And so at closing, you're going to sign the paperwork from the title company. There may be some lender paperwork, some attorney paperwork, but then on top of that, you're going to add a few pages from the QI. And so those documents are going to get signed at closing. The big difference is at closing, instead of you getting wired your funds or you getting a check for your funds, the IRS says that the funds have to come to the QI instead. And so what the QI is going to do is the QI is going to hold the funds in an escrow account pending your purchase. So they're temporarily holding the funds for you, following the IRS rules. So really what the QI is doing is these two roles. We're doing the paperwork for the 1031 exchange, and we're holding funds between closings. And so then what's going to happen is within 45 days, we're going to identify potential replacement properties. And we're going to talk about identification in a minute, so just kind of hold your questions on that. And then within 180 days, you're going to close on one or more of those identified properties. And when that closing occurs, it's going to be just as normal, going to have the title company paperwork, lender paperwork, attorney paperwork, and a little bit of paperwork from the QI. And then the QI is going to take those funds that's in the escrow account and they're going to wire them directly to the title company for closing. And so this essentially happens the same way that when you have a real estate loan, the lender wires the money directly to the title company on your behalf. And so once the closing is complete, the exchange is over because you've sold everything you're going to sell and you've bought everything you're going to buy, and all of the money has been used in some way. And then the only other thing that's going to happen is the next year when you file your tax return, there is a one-page form that gets attached to the back of the tax return. And it basically just takes information from the closing statements of the properties, and you report the 1031 exchange on the tax return. And so you can see very easy steps really laid out. Kind of the key thing to keep in mind is you got to hire that qualified intermediary ahead of time, because once you've closed, it's too late. So you got to do it before that first closing occurs. And the IRS says that if you hold the money or even have constructive receipt of the money at any time and it didn't go to the QI, that you don't have a valid 1031 exchange. So you've got to be really careful before that first closing to get the 1031 exchange set up. So, as you can see, there's a couple of time limits. So we've got kind of two time periods that we're dealing with. The first is the identification period, and so that's the first 45 days of the exchange. So the timeline starts when your sales transaction closes and funds. And so now we have 45 days to identify our potential purchases. And then our exchange needs to be over within 180 days. And the 45 and 180 days run parallel to each other. So the identification is the first 45 days of the exchange period of the 180 days. And the key thing to remember is there's no extensions. The IRS doesn't let us extend the dates in any way. And so, you just have to plan that these are hard deadlines. The deadlines also fall on whatever calendar day, not business days. So if your 45-day deadline ends at midnight on a Sunday, you got to have the identification over to your QI by midnight on the Sunday. You don't get till Monday morning to do it. Okay. So let's talk about identification, because that's a big word and we don't really know how to do that. So let's talk about it in two ways. The first is, how do we identify? And then we don't want to put all our eggs in one basket. So how many properties can we identify? So how we identify? Well, what's going to happen is, like, if you work with our office or any other QI, they're going to send you a form that says, hey, identify your potential properties, and this is due by midnight of the 45th day. Okay. And they're going to have the day printed on the form. And that form is just going to be blank, right? And so what you're going to do is you're going to write down either the property address, the full legal description that, is like on a deed, or you can give us the appraisal district property ID. So you could tell us property ID number 10,362, Dallas County, Texas. And that would be a valid property identification. And then you're going to sign that document, and then you're going to get it back to the QI by midnight of the 45th day. Okay. In our office, we use DocuSign, so that makes it really easy. Some of the QIs are still pretty old school, and so they still have people fax stuff, which I'm not quite sure who still owns a fax machine, but some of the companies do have you do that still. Now, so the question is, well, how many properties can I put on that form then? Because I really want to make sure that all my bases are covered. And so there's three rules of property identification, and you can use any of the three rules. Okay, so it's not even possible to comply with all three rules. So the first rule is what's called the three property rule. And so this one's really easy. So if I'm selling one property, I can identify any three properties, and we don't care what the value is relative to what you sold. So if I sell a $100,000 property, I could list three properties that are all $10 million a piece, and my 1031 exchange is valid if I buy at least one of those properties. Okay. The second rule is the 200% rule. This one is also really easy. So this one says I can identify as potential purchases more than three properties as long as their total value doesn't exceed double what I sold. So if I sold $1 million property, I could list 50 properties as long as their total aggregate value doesn't exceed $2 million. Okay. And again, in order for the exchange to be valid, I've got to buy one or more properties off my identification list, and I can't buy anything that's not on my identification list. And then the third rule is the 95% rule. And so what this one says is, hey, I can list more than three properties and I can exceed 200% of the value. But from my list, I basically have to acquire almost all of the list. I have to buy at least 95% of the value of the identified properties. And so, sometimes that's hard because, you get to 94.7 and you think surely the IRS will round up. Well, the IRS never rounds up in your favor. And so that 95 is a really hard target there. So you can use any of these three rules. Like I said, they're all mutually exclusive. But most of our clients are going to use either the three property rule or the 200% rule because those are the easiest to comply with. All right. Now we're going to get into a few more questions that are kind of taking the next step. So we've kind of laid the basics, and now we're going to add a few more contingencies onto it. So the first question is, well, how should I choose a qualified intermediary? And I want you to really think about this because what you're asking a qualified intermediary to do is to get your tax paperwork correct and to reliably and safely hold your money between closings, right? So it's a really important job. And I'll tell you, the IRS was not super helpful with this because they did not give us a whole lot of criteria to go on. What they said is that you have to have an independent qualified intermediary. And what they said is, okay, independent is defined as somebody who hasn't served you professionally in any capacity within the last 2 years. So, like your CPA can't do it, your personal attorney can't do it, your real estate agent can't do it. Anybody that's kind of worked for you is not going to be eligible. And then, other than that, the uh, the the government really kicked it to the states. And so the feds have no licensing or regulation in this area. So of the 50 states, only 8 of them came up with licensing or regulatory requirements, which means that in 42 states, including Texas, it's basically the wild, wild west. It means that in Texas or one of the 42 unregulated states, an 18-year-old who is alive and breathing and has not otherwise worked with you in a capacity within the last 2 years is eligible to be your qualified intermediary. And we're expecting this breathing 18-year-old to get your tax paperwork correct and to hold the money reliably, right? That usually scares everybody to death. So I always get asked, what should we look for in a QI to make sure that things are done well? Well, the first thing you want to do is you want to look for somebody who provides nationwide services. This is especially important because remember, we're not limited in where we buy or where we sell. And so what happens if the person you've chosen as the QI only does business in Texas, and then you decide to buy something in California, which is one of the regulatory states? Well, now you got a problem, right? So you want somebody that has nationwide coverage. The second thing is you want them to meet the most stringent requirements in the most stringent state. And so two of those requirements are that they have malpractice insurance, E&O insurance, of at least $1 million. And the second is that they have $1 million criminal fidelity bond. And so these are designed to protect you in case the QI does something wrong. The other thing you've got to be concerned about is how is the qualified intermediary going to hold my money? And so we want each transaction to be in a segregated escrow account. So we don't want any money commingled with anybody else's money, and we definitely don't want our money commingled with the QI. So we want a segregated escrow account that only has our money in it and never gets commingled with anybody else's money. And then that account needs to be under the exchangor's, the investor's tax ID number. It doesn't need to be under the QI's tax ID number. And the reason is because if the QI has a liability event, they get sued, they go into bankruptcy, something bad happens in their business, we don't want our money at risk. The way that I got into this business in the first place was when the largest qualified intermediary in the country went into bankruptcy, and everybody found out that the reason that all of the money that they held was held under their tax ID number. And so all of it ended up in the bankruptcy court. And so when that largest 1031 exchange QI in the country went bankrupt, everybody blew their 180-day deadlines that was their client. So this happened in 2008 at the same time the commercial mortgage crisis happens. It's just that none of us hear about it because the commercial mortgage crisis got made into the Big Short movie, but nobody has made the Land America movie yet. So I'm waiting on that one. And then the other thing you want to think about is you want to make sure that that escrow account is fully insured. So most people don't realize this, but your personal bank account is insured by the federal government for $250,000. That's it. So if you have more than $250,000 in that account, it's not insured. Well, the same thing is true of most QIs. The amount of insurance on an account is $250,000. So if you got $1.5 million in the QI's account, but only 250 is secured, what happens if the bank goes into some kind of regulatory downturn and gets sucked in by the feds and gets shut down? Well, now your money is at risk through the bank itself. So like one of the things that we have is each one of our accounts is insured up to $240 million with FDIC insurance. So you want to make sure that your QI has that capacity to insure. So as you're going through this process, look for a QI that's going to meet these six requirements because that's going to be your safest approach. A lot of people do ask, "Hey, is it possible that I could do a 1031 exchange, but also uh, still get some cash back?" And the answer is yes. If you want the full tax deferral, you want to pay Uncle Sam nothing, you're going to have to take all of your net sales proceeds and roll them into new purchases. Okay. But if you take some money out, it's okay. It's just that the money that you take out, you're going to have to pay capital gains taxes on. Okay. And so it's okay to do a partial exchange and then just pay on whatever you took out. How much do I need to spend on my replacement properties? Well, again, for the full deferral, you're going to have to buy at least as much property as what you sold. So if you sell $1 million worth of real estate, you've got to buy at least $1 million aggregate of real estate. Now, if you end up buying something less, it's okay, but it's kind of like getting cash back out of the transaction. And so you're going to pay some taxes because of it. So you're only going to do a partial exchange. But it is possible for those that need to do that. Um, so we're getting close to the end, but I do want to show you that a lot of times when we talk about 1031 exchanges, we talk about them monolithically, like there's only one kind of exchange. But there's actually four different kinds of exchanges. And so I want to show you those just really quickly, just kind of give you a broad overview so you know what tools are available to you as investors. So we've got the simultaneous exchange, the deferred exchange, the improvement exchange, and the reverse exchange. And so these are all used different ways. So the first one is the simultaneous exchange. And so what this means is, hey, we're going to do everything all at once, which means all of the property that we're selling and all of the property we're buying, we're going to close all at the same time. And this doesn't happen very often, but the most common situation it happens is when two investors decide to swap properties with each other. And so in that case, it's really easy to arrange the closing so that, everything takes place at the same time. The second one, which is our most common one, is the deferred exchange. And deferred exchanges make up about 94% of all 1031 exchanges in the country. Okay. And so a deferred exchange is kind of the one that we traditionally think of. Hey, I'm going to sell something, and then within the next 180 days, I'm going to buy one or more replacements. Okay. And so, again, what's going to happen during that time period is the QI is going to do the paperwork for that exchange and hold the money between those closings. So, this is kind of the one that we're really used to. Then we have a couple of weird ones. The first is the improvement exchange. And so with the improvement exchange, what we're going to do is we're going to sell something and we're going to buy something new, but we are going to have excess 1031 funds. And so that new thing that we're buying, we're not just going to buy it, we're going to use the rest of our 1031 money to also improve that property as well. So this one is a really, it kind of makes the investor have even more equity because they essentially become kind of like a home builder where they're going to add additional equitable value to the property by making those improvements. And so this one is a little bit more complicated because what's going to happen is the QI, because of the IRS rules, is going to have to take on a third role. So usually we're going to do the paperwork and hold the money, but the IRS says while we're spending the balance of those leftover funds, the QI has to temporarily hold title to the property as well while the improvements are being made. And so what this looks like is we're going to form an LLC and we're going to buy the property using the client's funds in the name of the LLC. And then the client is going to manage the construction. They can hire a general contractor to do that, or they can do it themselves. And they're going to give us invoices for work that has been done and that they approve of. And we're going to wire funds to those different contractors and vendors. And the key thing is we still have that 180-day period. So starts when we sell, it ends at 180 days. And the key is that we're going to try to use all of the 1031 exchange funds within that time period. Oftentimes, that's really easy to do because a lot of times our clients will have a bigger construction project. And so we'll use the 1031 funds. And they also will have a construction loan. And so once the 1031 funds are exhausted, they'll start drawing on their construction loan. All right. Then the last one, the reverse exchange. So this one, we're going to do everything backwards. And so on the reverse exchange, instead of selling and then buying, we're going to buy first and sell second. Okay. And so why would we do this? Well, a lot of times our clients find a really good deal. And when they find that property that they love and that they can get a really good price on, unfortunately, usually the seller of that property is not going to wait. And so there's no contingency contracts allowed. They're not going to space it out very far. And so a lot of times our clients are time pressured to go ahead and buy that property. And so again, the QI is going to take on that third role. So we're going to do the paperwork, we're going to hold money, but we're also going to temporarily hold title. And so what it looks like is we're going to form an LLC to buy the new property on the client's behalf. So we're going to buy that first. And so what the client is doing is they're loaning the money to the LLC to do that, or they're getting the lender to loan money to the LLC to do that. And then what's interesting is at 45 days after the purchase, instead of identifying what we're going to buy, now we're going to identify what we sell. And this one is usually pretty easy because our clients are wise about what properties they own. And then within the next 180 days, they're going to sell one or more properties. And when those properties sell, the money is going to come to the QI at closing. And then what we're going to do is we're going to pay the client back out of those funds for any money that they put towards the purchase of the new property. And if they have leftover funds and they have a lender, we're going to make a principal reduction of that loan as well, maybe even pay it off. If they still have money left, we may add on some improvements as well to that property. And then when our 180 days ends, we're going to convey that property back to the investor, right? And so again, it's the same. They're selling something and they're obtaining one or new replacement properties in exchange for it. So conceptually, it's the same. All right. So we're going to start moving towards a few questions. The one thing I do want you to remember is in order to do a 1031 exchange, you really got to do two things on the front end. The first is you've got to hire your qualified intermediary because that paperwork has to be signed before the first closing. So once you close, it's too late. And then the second is you're going to want to make sure that there's cooperation clauses in the contract. And so again, I've got a couple of cooperation clauses here that you guys are free to use, but make sure that you get that QI in place before you decide to sell that property if you're wanting to do a 1031 exchange. Okay, so we are right at 50 minutes of presentation. And so, Dustin, I may let you kind of MC the questions, and we'll play a little game that I like to call Stump the Chump, and I'll try to answer whatever you guys have. While we do that, though, if you guys will help us out, if you like the presentation and found it really helpful to you, take a quick pic of the QR code and leave us a nice Google review and leave some nice comments and a 5 star. If you hated the presentation and thought I was incredibly boring and don't like math and taxes, forget I asked. Okay. But while I have this up, then I'll take some questions. And then the next slide will have our contact information in case anybody needs to follow up with us. So
Yeah,
what do we got?
yeah, appreciate that. We don't have anything in the chat right now, but I'll just kind of, open it up to everyone. Do you have any questions for Chris? Anything, we've got him for a few more minutes before we conclude this, but yeah, I'll just kind of open up and see if there's any questions. And Maul kind of waiting on that. I guess just kind of,
I have a question.
oh, go ahead.
Hey, thank you. Appreciate the information. It's been great. Sort of, I guess I'm in the weed with this question. I'm a realtor and I have a home office. If I want to sell my home property, could I use that in a 1031?
Potentially, but I'm not sure that I would do it.
Okay,
So you might be able to allocate between the home office and the rest of the house, kind of like that fourplex example that I gave. But
right.
the truth is, most people who work with taxes tell you that the home office deductions that people sometimes make tend to be the things that is a potential audit flag with the IRS.
Mm,
So at least my CPA has advised me not to take those deductions. But aside from that, the reason that you don't want to do that, do a 1031 in that case, is because you have the advantage of that 121 exemption already. And so
right.
when you sell your personal home and you've lived in it for 2 of the last 5 years, then you're able to figure out what the capital gain is. And whatever that capital gain is, if you're single, you can keep 250,000 of it tax free without even buying another property. If you're married, you get $500,000 tax free. So
Mm,
that's really a better deal because it's not tax deferred, it's tax free. And so I
like,
would I would definitely kind of lean towards doing that when you're selling your personal home.
Makes sense. Thank you.
Willie, do me a favor. Are you a realtor in Texas?
Georgia.
In Georgia. Okay.
Yes.
Thanks.
Mhm. Thank you.
Good. There was a question. Travell asked, "Can I buy as an LP in a 1031?" I'm not sure exactly if I don't know if you're able to
Yeah,
unmute yourself and or
let me kind of deal with that in a couple of different ways. Okay.
yep.
So the first is, hey, can I sell real estate and can I directly buy the limited partnership interests? The answer to that is no, because limited partnership interests are an interest in an entity, not in the real estate itself. But there are ways to do this. And so kind of our most classic example is a lot of times we will have a client that sells something and they will buy as a tenant in common with the limited partnership. And so the limited partnership will sell them a percentage of the underlying property. What that does is it makes them and the limited partnership a tenant in common. And then after closing, they can actually contribute back that interest in the property in exchange for limited partnership interests. And so what we've done is by breaking that transaction into a two-step process, we've fulfilled the requirements of 1031, but still allowed them to become part of that limited partnership. So that's typically how we would do it. A lot of times we also have kind of the same thing when people are getting out of a limited partnership and they want to 1031 exchange it. And so oftentimes we do something that's called a drop and swap. And so what we'll do is we'll take their limited partnership interest and we will convert it back into a tenant in common interest where they own a percentage. And then they can 1031 exchange into new replacement properties because they're now selling an interest in real estate, not selling an interest in the business. And so there are ways to do this with limited partnerships that work really well. I was telling Dustin and Hayden before we started the chat that we have some home builders that this is kind of what we do with them, where they've got investors and we have the investors buy property and then they end up forming an entity with the builder and contributing the property as part of the capital investment into the new entity. And then, they get their profit share and stuff through the entity at that point. So you can do it. You just have to kind of break it down into its component pieces to do it. But that's a great question, Travell.
Chris, I've got kind of a follow-up question to that. Say, for instance, we're going to sell a property and then we let people know that, hey, we want to do a drop and swap, right?
Mhm.
Are we able to have multiple people a part of that tick to go and then buy that new piece
Yep.
of property, or do they all have to be individual?
Yep. So let me give you a great example of this. Okay. So you can do this in a variety of ways, but this is kind of a good example that we did very recently. We had a client that was selling an office building, and the client was actually a LLC. Okay. And there were three partners in the LLC, and they each wanted to do their own thing. Okay. So one of the partners wanted to cash out and just be done. Okay. One of the partners wanted to reinvest in some student housing in Texas, and the other partner wanted to buy some condos in Florida. Okay, so we got three very distinct things. And so what we were able to do was slide down out of the LLC, drop and swap. Okay, so we dropped it back where they became tenants in common, and then each of them did their own thing. And so two of them, we did 1031s. We did 1031 for the Florida condos. We did the 1031 for the student housing in Texas. And then, of course, the third person just sold and got their cash at closing and just was done. We've also done it where we've had multiple partners and where a group of a couple of them wanted to stay together, and so they reinvested together and then formed an entity on that end. So there is a lot of flexibility there that people don't really realize, because it's very common for us with investment groups where they just think, oh, well, the business is selling it. We don't want to keep all the same investors. And so we're just going to have to cash everybody out. But you actually have a lot more, uh, you know, arrows in the quiver that you can use to meet everybody's individual investment goals.
Right. That's pretty cool.
Yeah, no, it's great. There's
Also,
there's a lot of cool things you can do with 1031 exchanges if you plan them out early.
yeah, this has been a lot of great information, and I believe Travell he said he's a commercial or he's a real estate agent in Texas, and I think Chris you had said this qualifies for
Yeah,
some education hours.
we've got it. Unfortunately for the last guy that asked a question, I'm sorry, the name escapes me. I think it was Walter, but we don't have it approved in Georgia yet. But Travell, if you will drop your uh, or I'll tell you what, I'll give you my email address. You send me your Texas license number. This qualifies for an hour of free CE in Texas. And so if you'll send me your license number, I'll make sure that my staff adds it to your CE credit. Um, And then I just went ahead and put up a slide with our contact information. So if you guys want more information, feel free to reach out to us at Wealth Builder. I I'd ask you to take a look at our website because there's a lot of cool stuff on there. We've spent a lot of time. We completely redesigned our website about 2 years ago. And so it's got a capital gains calculator on there that's really easy to use. It's got a 45 and 180 day calculator. So if you anticipate closing on September the 15th, you can kind of figure out what your deadlines are yourself. There's also a lot of like frequently asked question videos on there, and we put out a lot of material through the website. So take a look at it if you get time, because you might find something that's super helpful. And I always tell folks the same thing. Feel free to use our materials as long as you give us credit.
Cool. Awesome. Well, yeah, really appreciate your time today. Please, everyone, feel free to reach out to Chris and Sarah. I love the name of your company and website, Wealth Builder. So,
Thanks.
anyways, but yeah, really appreciate your time. And then, yeah, looking forward to chatting more. And if anyone who came on here a little bit late or had to leave a little bit early, we'll be sure to send out the recording as well. So just appreciate your time, Chris. Thank you very much.
Yeah, thanks so much. I appreciate you guys having me.
All right. Have a great Friday. Take care, everyone. See ya.
Thanks, everybody.
Thanks. Bye.